Good Tuesday morning. Welcome to Opening Bid. I'm Yahoo Finance Executive Editor Brian Sozzi. I'll have something to say on earnings out of General Motors in just a second, but I didn't want to gloss over what we are seeing in the precious metals markets right now, because it's blowing minds, friends. What we are witnessing is a real frenzy, not unlike a few years ago when Nvidia's earnings totally shocked the world and sent AI stocks off into the stratosphere. Gold prices closed above $5,000 an ounce for the first time ever on Monday. The gains have continued into today, with gold now above $5,100 an ounce. Gold is up, get this, almost 20% in 2026. Deutsche Bank out today saying gold could hit $6,000 an ounce this year, provided the dollar stays weak, which is normally a conducive backdrop for trading commodities to the upside. Silver gave up almost all of its insane 14% intraday gain yesterday before resuming its rally today. Get this one, silver is up close to 60% this year. That is an absolutely massive move for silver, totally out of the blue. Yesterday, retail traders poured about $171 million in net buys into the iShares Silver Trust ETF, according to data from Vanda Research. That's SLV on the Yahoo Finance platform. This is the largest single-day net retail investor inflow on record. This isn't just an ETF trade, though. Retail investors are rebuilding broad exposure to real assets. Just look at metals plays. Hecla Mining and Core Mining both have surged into the top 50 most actively traded stocks. Bottom line here, we are smack in the middle of a metals price bubble that is showing no signs of easing up. If you aren't partaking in it, ask yourself this and be real. Why are you sitting this dance out? Real quick on General Motors earnings, here's what I liked and why the stock is moving higher. One, a 20% dividend hike and a new $6 billion share repurchase plan were both revealed. Both were unexpected. Two, the company is over its EV push and is locked in on driving more margin gains this year, no pun intended. Three, GM calling out 12 million OnStar members and new AI features arriving to cars suggests it deserves to be viewed partly as a software play. Now, GM is no test on software. I'm not trying to say that, but still, it's doing good things on this front for the business, so it might deserve a higher multiple than a traditional automaker. That is all I'm saying. Don't let me have it on X. I don't want to hear it. Here on the Opening Bid Roundtable, Art Hogan, B. Riley Wealth Chief Market Strategist, alongside Yahoo Finance Senior Reporters Brooke DePalma and Inez Ferre. Inez, I want to start with you, because what we're witnessing in the metals market is it's stunning. I think that's the word I want to use here. Last week, it was a rally, and we were watching the buying activity emerge. It's just flat out stunning right now.
It is stunning, and Robin Brooks of the Brookings Institute called it breathtaking and profoundly scary, what we're seeing with the precious metals market. Look, I think in your opening comments, I mean, you laid some of this out. Geopolitical issues, you've got resource stockpiling, there's the debasement trade that is happening is something that has been accelerating since last year. And if you take a look at what gold at 5,000, I mean, Brooks was from Brookings Institution was talking about this is much bigger. The gold rally is part of something much bigger, because you are seeing all the metals which are rallying, and you are taking a look at now a dollar that has started to decline because it was consolidating in the second half of last year. And so this debasement trade is expected to even now accelerate it with the dollar declining, because that gives more purchasing power to non-dollar buyers. But so much of this has to do also with the fact that you are seeing government debt around the world, and the markets are increasingly scared that governments will have to inflate away their debt. So there's a myriad of issues that are going on with this entire bubble that we're seeing in the precious metals market. And yes, yesterday you saw silver that was at 115 an ounce at one point. And you are seeing, of course, a silver squeeze to some extent. And you are also looking at, you have strategists that are saying, watch out, because you are going to be seeing this going lower at some point. But nobody wants to call a top yet, because it's very hard to call a top at these prices.
Art, hot potato to you. You want to call a top on precious metals?
I don't. You know, what's interesting here, Brian, is that the gold breakout happened 2.5 years ago, and that was after breaking a 45-year inflation-adjusted base. So momentum players started to notice that. Not surprisingly, 2.5 years ago or thereabouts, the SWIFT system froze assets because of Russia's incursion into Ukraine. And then central banks and governments and oligarchs started saying, well, if they can freeze these assets, perhaps we need to have more hard assets on our balance sheet. So central banks, for example, went from buying $7 17 tons a month to 25 tons a month as of last week. So central banks are a big driver here, and that's not slowing down. But to Inez's point, neither is geopolitical uncertainty and fears of inflation. So I think all of the drivers are still intact. We could certainly have some pullbacks here, but I don't think we're going back to anywhere close to what last year's lows were. And I think the momentum players and certainly the fundamentals continue to move the precious metals higher.
Art, humor me here. Quick short story. A couple days ago, I went to get my eyes checked, needed some contacts, totally ran out. I just forgot that I even needed them. My eye doctor said, Brian, I sold my gold 3 or 4 years ago, and I'm just out. They didn't want to get back in, but I know I want to get this question from people, Art, like, is it too late to get in? How would you, if you were not invested in gold or silver right now, what is a rational way to go about it?
Well, 3 things to answer that question. First and foremost, he sold his gold. He might have held the precious metal. ETFs are a perfect way to play this. And certainly expect some pullback in both gold and silver and use that as a buying opportunity. So the gold-silver ratio, which is about 1,000 years old, is a ratio of gold to silver that sits somewhere between 50 and 80, right? And silver was out of whack. That's why we've had the explosive move. Now the gold-silver ratio is above 90, so silver's probably gotten ahead of itself, and that may be one of the precious metals that has the first pullback. I think the fundamental drivers are still here, but I would use pullbacks as an entry point, and I would certainly use ETFs. You don't need to buy the precious metal and store it in your basement in a safe.
Brooke, full disclosure, I'm reading that General Motors slide deck this morning, and they note in their guidance for this year, commodity cost headwinds. And I thought, oil prices are down, and I'm guilty of thinking when a company calls out commodities, it just means oil. And then I'm like, hold on, Brian, well, that's not the case. I mean, a company like GM is using a lot of metals. So I imagine this is one of the first indications, this move in various metals, this explosive move you've seen really across the board is going to impact large companies.
Yeah, well, we're hearing from GM this morning within their presentation under their 2026 guidance under headwinds. They specifically pointed out that commodity inflation, including higher memory disk cost, DRAM costs, and FX headwinds of roughly $1 to $1.5 billion as a potential headwind. And this really goes to translate how these higher commodity costs are really impacting real world things that you and me, beyond just investing, are purchasing, out and about, new vehicles, new cars. And they also mentioned within that headwinds is that onshoring production to the U.S., supply chain investments, and higher software expenses also resulting in a $1 to $1.5 billion of additional costs. And the last thing that they noticed as a potential headwind for 2026 guidance is also those lingering tariffs. They said that gross tariff costs of $3 to $4 billion are slightly higher, primarily due to additional quarter of tariff exposure. So definitely this guidance, though, not really seeming to impact investors, slightly shrugging this off as the call is still underway.
And as I'm looking for the folks that for the past few years have called Bitcoin digital gold. Where are they, Inez? Because we're not seeing Bitcoin rise in concert with gold or silver. Where are these folks? Tell me where they are. I want to find them.
No, they're not. Look, Sean Farrell of Fundstrat keeps saying that the fact that gold has rallied so much, this will eventually be good for Bitcoin because it tends to precede a rally in Bitcoin. But nevertheless, they are getting taunted by the precious metals holders who are basically saying you should be buying precious metals. You should have been buying precious metals. And look at what's happening with Bitcoin. It's hard to see Bitcoin rallying at this point, especially because of that market structure bill. It really needs to pass in order to, that needs to really be the next catalyst for the crypto space. But just getting back to what you were talking about with Art earlier as well. Look, there are some strategists that are pointing to this structural shift that you are seeing away from U.S. Treasuries and with portfolios that are starting to look at like a 30% of your portfolio now in gold. So there is a structural shift, and this has to do with also demand for U.S. Treasuries that is happening. And part of what we're seeing, part of that reason of why we're seeing gold at these levels as well.
And as Costco, they sell those pizzas. They also sell gold bars. They got to come out with like a gold leaf pizza. Limited time, it is.
Yeah. And those are... Those gold bars, they sell out, but I will note that there are some people that are trying to sell at least their silver bars. If you go on social media, you will see that some are trying to go to their dealers and they're getting lowballed for those silver bars. It's harder to sell bars than it is to sell coins. That is something to note as well.
Hold your Costco gold bars. Art, I want to go back to industrials. We talked a little bit about General Motors here. We've seen a rotation this year into industrials. Everybody thinks these are now value names, but I look at this General Motors report. I know the stock is popping. I didn't like they called out commodity cost headwinds. Didn't like they called out billions of dollars another year this year of tariff impacts. Are investors forgetting about the risks in some of these value areas or perceived value areas like industrials?
That's such a great question, Brian. But I think when you look at in General Motors itself and its report, even with today's pop, you're looking at a company that's trading 7 times forward earnings. So the value proposition is still there. And this broadening out we've seen in the market, which started in the fourth quarter of last year and certainly has played into the first quarter of 2026, I think is going to continue. So therefore, investors are saying, where do I get a better value for my investment dollar? And industrials and materials are certainly falling into place here. I think healthcare and financials will eventually be the other two groups that follow along in this value trade. It's just a case of looking at multiples. And if you look at the industrial sector of the S&P 500, you're looking at a group that trades at about 10 times versus obviously the technology sector that trades closer to 30 times.
Brooke, it also caught my attention, that slide deck, and you mentioned this too as well. I think it was at Slack. Another win for Google Gemini with General Motors. And I was imagining myself, I have a Cadillac Blackwing, bought it used, no big deal. Love the car, it's absolutely amazing, super fast. But I don't know if I want to sit in my super fast Cadillac Blackwing and talk to Google Gemini and craft my text messages. I'm not there emotionally yet, Brooke.
Well, I have to say that this is another win for Google Gemini for sure compared to, we haven't heard too much from OpenAI since the start of this year. But what we did hear this morning, as you can see on your screen, is that they are launching this partnership, GM, with Google Gemini. And starting this year, as you noted, drivers can use this Google Gemini AI technology to draft messages while driving, I guess. And they all say that this is part of their full second generation software that will debut in 2028. But I think this sort of just goes to show the way of the future, how this technology is integrating not just into work and everyday usage, but also within how we're thinking about road trips, perhaps. I mean, it kind of makes it seem like it would be easier to text friends with a suggestion as opposed to, texting and driving definitely don't do that. So maybe a way of the future indeed.
Art, I know you like Google. I think when we last talked to you, you were bullish on Google, right?
Yeah, I think Google's got multiple things going right, and not the least of which it appears as though Gemini is the leader of the pack in the large language model race, but also all of its deals it's done with Apple, which continues. So obviously Gemini is going to be the part of Apple Intelligence that actually brings forward Apple's AI strategy. I also think that the fact that they won a case with the government allowing their browser to be the dominant browser on 2.5 billion Apple devices continues to be the driver there. And even with the run, it's the best performing of the Mag 7s year to date. But I think even with that run, I think there's a lot of runway in front of these guys.
I gotta be honest, though, I just miss good old crappy 80s cars like my parents' white Ford Escort. I mean, you just got in it, you put the seatbelt on and you drove. Maybe it drove, maybe it didn't, but at least you know you were getting. Now with all this technology, man, we just sounded old. All right, hang with me, guys. We'll be right back. Lots more coming up in this show. We're just getting warmed up here. We are coming in hot with some sharp stock analysis next and a spicy final thought on your favorite dying retailer. ... GameStop. Is negativity on charge card stocks maxed out? As corporate middle managers would say in a Google Doc, TBD. But here's the backdrop in which Visa, MasterCard, and Amex will all report earnings this week. President Trump this month wrote on Truth Social that interest rates on credit cards should be limited to 10% for 1 year, starting January 20th. That date has come and gone with no clear insight into the Trump administration's next move. Here's what outspoken JP Morgan CEO Jamie Dimon had to say about this at the World Economic Forum.
It would be a economic disaster. And I'm not making up because our business, we would survive it, by the way. If you, in the worst case, you have to have a drastic reduction of the credit card business. I mean drastic. I mean like 10%. I mean like 80%. It would remove credit from 80% of Americans.
Who am I to argue with Big J? Wall Street agrees with the outspoken Dimon. Evercore ISI analyst John Pancari says card lenders would see material negative impacts to profits. Shares of Visa, MasterCard, and Amex have all sucked wind in January, with Amex being the top performer with a drop of only 3.1%. Let's put it to the opening bid roundtable. Art Hogan, Brooke DePalma, and Inez Ferre. Art, are you a buyer of these stocks on the dip under the view that this cap just never happens?
Yeah, it certainly seems that over the course of the first month of this year that the administration is throwing a lot of things against the wall that sound relatively populist and might be popular unless and until you look at how well they function. So I think Jamie Dimon pointing out the fact that putting that limit on credit cards will take away credit from people that need it the most, and some 80% of people, and they'll be forced into more dangerous places and higher interest places, buy now, pay later, or pawn shops, et cetera. So I certainly think this is one of those things that was thrown up against the wall that won't stick, and I'd be a buyer of the credit card issuers, and certainly of Visa, which is one of the names we have on our focus list.
Why do you like Visa over the rest of them?
Well, I think the best of the operators, and on a multiple basis over the course of the last year, they're trading at a better multiple and throwing off better cash flows than MasterCard. But it's Home Depot, Lowe's. It's one of those things. Either one is a great company. Visa just happens to be the one we landed on.
Brooke, I would agree with Jamie Dimon. I do think this would be a real disaster for the economy, more so than Winter Storm Fern.
I definitely think that if this should happen, that these companies really need to rely on other potential business segments in order to sort of offset the impact that this would have on the company. Also, just big picture here, it just goes to show this push by President Trump as affordability remains a key topic ahead of the midterm elections as they tried to ease Americans' feelings that everything is too expensive right now, that year-end inflation could increase, albeit based upon the latest University of Michigan consumer index, we have seen that year-end inflation expectations tick down just a little bit, but it seems like someone said on this panel, really throwing everything at the wall here to try to get that message to Americans.
And as this is the last thing I would argue the U.S. economy needs. We're right at the beginnings of an AI infrastructure build out. You have potentially this spring some very large tax refund checks coming. This is reducing credit or contracting credit doesn't equate to a rip-roaring economy.
No, and that's precisely one of the points that these companies will be making as well. And look, like what Art was saying, this is a populist sort of move. It is part of President Trump's affordability push, but probably there may be a compromise. I mean, you have a report from Reuters talking about Bank of America considering a 10% card as a competitive product, but they won't necessarily be putting a 10% cap. I mean, to do this would really upend the entire industry. So there may be some solutions that these companies may be saying, look, we can come up with a product like this, but not putting a cap on their products in general.
All right, let's keep it moving here. I'm calling my chart of the day the grand rotation. I love whipping up random terms to capture the essence of the market. I live for it, actually. After several years of tech giants getting bigger and bigger market caps and dominating the makeup of the S&P 500 like never before, a different dynamic has emerged this year. The weight of the top 10 stocks in the S&P 500 has recently seen some major weakness relative to the rest of the stock market. Thank you, RBC Capital Markets. Lori Calvasina for this nifty chart you are looking at right now. The chart is primarily made up of the Mag 7 tech giants. Sentiment on tech has soured as fears of overspending on AI infrastructure ratchets up. Expect many of the tech companies this week reporting earnings to hike their CapEx plans, believe it or not, much to the dismay of investors. I am most concerned about what Meta will say on this front. Investors have rotated out of tech and into more value sectors such as healthcare, energy, industrials, with these spending fears swirling. Let's put it to the OB roundtable. Art, it's in one respect, it's good to see a more rational market, but you look at these 7 stocks, you can't argue their importance, but you also can't argue that the next series of quarters are going to be huge from top and bottom line perspectives. Maybe not for Tesla, but the rest of them.
Yeah, for sure. And I think one of the things that the chart highlights is just how much the move has been on a 3-year stack. So I think it's important to say, have these things gotten ahead of themselves? No, they've consolidated nicely. NVIDIA is basically where it was when it reported earnings last quarter, and the rest of the group, Alphabet, which has been the top performer, has really moved sideways. I think that can be healthy. That consolidation can be very healthy. If we think that we're in the late innings of the artificial intelligence revolution, then perhaps this move is sustainable. But I just think that as we work our way through earnings and the hyperscalers talk about how much more they need to spend to get to that agentic large language model dream, I think this company rates higher. And certainly, if you look at the average multiple of the Mag 7 and back out Tesla, you're trading at 30 times for companies that typically are growing their earnings between 40 and 60% and have gross margins that are north of 60 to 70%. So I think that we've created, or we're in the process of creating, a group that looks much more attractive as we head into earnings this week.
And as outside of the move in precious metals, which has been, in my view, the story of the year, the second story has been the broadening out of investors. So they're thinking beyond these 10 large companies, which includes the like of a Berkshire Hathaway and a Broadcom, and dare I say, that's healthy. Hats off to them that there are 490 other stocks to buy in the S&P 500. Good for them for finding them.
Yeah, and this is what strategists have been talking about, that this would happen this year, that you would see a bit of a broadening out. I mean, you are looking at year-to-date energy stocks are the biggest gainers. You're looking at materials, industrials that are higher as well. You also have the big, beautiful bill, the tax benefits, tax incentives, and this is also what's driving some of these more cyclical stocks as well. So they are going to be saving tremendously from this big, beautiful bill and all the infrastructure that they're also building as well.
Art, last word to you on this front. I know you mentioned previously that you like Google. What are your thoughts on NVIDIA here into earnings? I believe they report in mid-February.
Yeah, so obviously we're in the earnings Super Bowl right now. The NVIDIA's reports like the earnings Pro Bowl. It comes after the season, and we get to find out just how well they're doing. This is the cheapest NVIDIA's been for about 3 years. So when you're trading at 25 times forward, which is going to go down after the report because they're going to raise their guidance, they're the tip of the sword for artificial intelligence spend. So I just think that if anything, NVIDIA is only going to reinvigorate the trade. I agree with Inez on the broadening out, which puts us in a much healthier place. But the consolidation in the Big Ten certainly sits in a place where they're getting a whole lot more attractive in real terms.
Big thanks to Art, Brooke, and Inez for being on the roundtable. Always great to see you all. I appreciate it. Stay warm out there. Final thought before I head out to de-ice my car. I continue to watch GameStop, a company I've criticized heavily, I mean heavily, the past decade for horrible execution by management and an outdated business model. Michael Burry, the investor made famous by his bet against the U.S. housing market ahead of the great financial crisis, has disclosed that he has been buying shares of meme crowd-favored GameStop. He apparently is a big fan of CEO Ryan Cohen and what he is doing there, whatever that is, because details have been minimal at best, with an emphasis at best. Cohen is GameStop's largest individual shareholder. Here's what I say to Burry and other GameStop stock pumpers. GameStop stock is up 45% since Cohen took over as CEO on September 28, 2023. The S&P 500 is up 62%. In the past 5 years, GameStop shares are down 70%. The S&P 500 is up 87%. So let's chill out in anointing Cohen the next Warren Buffett for buying into a company that is dying, building up cash reserves, and figuring out ways to deploy it all. Look how this praise worked out for money manager turned failed Sears leader and investor Eddie Lampert. Sears no longer exists, and Lampert is nowhere to be found. Have a great rest of the day. Julie Hyman is up next.